I'm Robert Maltbie. Welcome to Maltbie's Minute on the Market. I'm back at the home office in Southern California after being out on the road doing research. And so into 2018, let's talk about what is going to happen and how to prepare for it. Get a ticket to ride. It's going to be a bumpy one, no question. Volatility is on the ups after being dormant for over 3-4 years. Let's look at the well-known January indicators. Last year we looked at the Super Bowl indicators that had a high batting average. Didn't work so well. So let's look at the January indicator. 80% of the time it is right. And if the market's up in January, it usually is up for the year. So 80% accuracy, we've had up January. Let's talk about Facebook versus Bitcoin. This is recent news, as Bitcoin is, well, some of the air is coming out of it, and the most recent enemy of Bitcoin is Facebook, who just today announced that they're going to ban, Big Brother Facebook will ban advertising of Bitcoin on the website. Is it 1987 again? That's one of the questions being tossed around. Well, there are some similarities with a weak dollar and higher rates and higher volatility. And I think that's where it ends. We're in an extended market. It is overbought, and that's a good thing. The good is really good. And here's what it is. Spurred by these tax cuts, which we'll get to in a second. Liquidity, money coming into the market through mutual funds and ETFs. Earnings momentum, very strong, spurred a lot by the animal spirits confidence and tax cuts. Expected earnings up 18% this year, it's a very high bar. The leading economic indicators up 5.7 year over year. That's a solid underpinning. The impact of the tax cuts, big shift, big secular shift from FinGin with financial engineering, taking money, buying stock back, share buybacks, M&A, layoffs, financial engineering to get the earnings up, versus tax cuts combined with accelerated depreciation, resulting in real growth, real investing with CapEx. That's what we're talking about. To the bad this year, rates rising a bit, margin accounts pretty levered on the New York Stock Exchange, and sentiment right now about 2-1. The bulls outnumber the bears. Not always really negative. In this case, we don't think so. Bottom line, right? The S&P target and fair value in our discount valuation model is 3,100, which is an increase in total return potential heretofore of roughly 10%. Worthwhile, meaningful return still. What if it's 1987? Well, it depends when you buy. And we say the earlier the better, because 87 turned out to be a decent year if you bought early. But of course, the later you bought, the worse it is. So there you have it. Get your ticket to ride. Expect that volatility. Stay on board. It should be good, driven by the tax cuts. I'm Robert Maltbie, Maltbie's Minute on the Market. Visit our website for individual ideas in a full report at millennium-asset.biz. Thank you. Buckle up.